the quantitative easing era, monetary policy. You were around when Volcker didn't care about the markets. And it was a much different kind of a relationship between Wall Street and the Federal Reserve. How has that influence, in your view, historically speaking, changed? And more importantly, can the Fed ever stop? We've been told in the last few months that QE is now an official tool in the toolbox and that they will be using it on a regular basis. And I think the market has priced in that they're never, ever going to exit.
One of Biden's potentials was to dig up Arthur Burns, who Volcker worked under, by the way, when he was head of New York. Market is addicted to the Fed. Okay, we were addicted to some degree to buybacks, but the liquidity issue and the buyback is in there. I don't think you can make a good case that if they didn't do what they did, that during COVID, we would have these kind of markets. I think it would have been a lot more damage out there, significant damage, whether you measure by unemployment, companies, whatever it is. So liquidity possessive. Could they have done better? Historians will go back and say yes or no, but we have gotten addicted to that. And the Fed has signals that this will continue for a while. So the market has this built into every spreadsheet. No one's looking for the 10-year to go back to 16% Jimmy Carter times. Not, 1.6 maybe you'll see on a couple of longer term ones, not even next year or the year after. So yes, the market is basing these in, that liquidity is there, financing is in there, and that you will buy anything out there that is broadly considered fixed income, regardless of how it's classified. 40
years of low interest rates, every once in a while in history, it's rare, but every once in a while, the market takes off and does its own bidding. I mean, theoretically, there's a bond vigilante left somewhere. They can't all be dead. What would interest rates being taken out of the control of the Fed, long maturity, what would rising interest rates, how would that factor into the market today? Because there's a lot of chatter about the potential for the bond market to divorce itself from monetary policy. That's just the chatter on the street, that we're going to be in a rising interest rate regime, that we're going to have fiscal spending as far as the eye can see, and that at some point that the Fed's going to lose control.
Obviously, higher deficits, and yes, inflation will eventually come back. Not to hopefully the Carter times, but to where it's well above that anywhere near 2% range on. But as far as the market goes, okay, right now we've got short term, you've got the numbers. So you assume that going forward, one of the scenarios, one of the branches, much higher spending, potentially borrowing through their creation on there, the expense on corporations. And again, we're looking from the market perspective. Mm-hmm. Okay, higher interest rates, but we are so far down compared to where it was 5 or 10 years ago. These numbers are significantly down, even with higher debt. Okay, I mean, a lot of numbers of when companies try to refinance, they've got to buy bonds that are much higher, calling them in on there. We haven't seen that since the 80s, Jenny Mays and those. So yes, higher interest rates will hurt the companies, but it'll also put money back. If we get a general increase, all those investors we mentioned going into CDs and there's a lot of money sitting on the side. If it does not go into stock, they're going to get at least some more income in there. The corporations have enough sufficient cash on hand, access to liquidity, and in general, cash flow. Cash flow is not what it was, okay? Earnings are not what they were, especially when you do a cash flow. Remember, a lot of these charges were non-cash. It's a paper charge. It's going to change your depreciation. It's going to change your GAAP numbers, but the cash flow is different on there. Okay, so the companies on next several years, even if we get higher interest expense, we're going to have more stimulus, and they should more than compensate for that. From a market point of view, again, inflation farther down, higher interest rates down, how you pay for the deficit, how those bonds that are maturing okay, if all of a sudden it's not point something, but, much higher numbers, very valid. And if you were to do this for a 20, 30 year, it's an enormous amount. I think you would put it on your top list of concerns for the economy. Looking at the debt levels, whether you want to do it as a percentage of GDP, whether you want to do whatever you want to do, average cost of capital to the government, with the debt going up as well, expected to go up more, is going to be a problem. Shorter term is a different situation, and the market obviously is a different interpretation.